check him out there, and highly recommended that you at least check out his video content for more free value. Ivan, thanks for coming on, man. Appreciate it.
Thank you so much for having me.
See ya. All right, guys, up next, we got Chris Pulver taking over the show here for a little bit, and maybe actually seeing Chris Pulver in person the next few days could be a fun little hangout session. If he comes by, we might have to do a little bit of content together for a few minutes, just get a little bit of an interview going. That might be fun, but I'll stick around with Chris for just a few minutes, and then I got to run, but we'll come back to Chris in just a second. Before I do that, just a reminder, Edgefinder 45% off discount is going on right now. It's our biggest sale discount of the year for the Edgefinder. If you want some information on that, we'll drop the link here in the chat to where you can speak directly to our support team about getting access to the Edgefinder. It's a one-time payment, 45% off right now. Send us a direct message using this link. Up next, joining us is Chris Pulver.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
All right, we're back with Chris. What's up, Chris?
What's up, Nick? How are we doing today?
Craziest day I've seen in a long time in markets.
For
down
sure.
5%, back to break even for some of the indices, was up just a second ago, back to flat. Crazy, crazy stuff. And I might be seeing you this Thursday too. That's crazy.
Very possible. I'll finalize everything for the trip. Like I said, I probably not the greatest time to be like, let's just have a casual week away from the markets. So that's probably not the case. But I'll turn it in. I'll turn it into work week. But it's a good reason for me to get out of the office for a couple of days. And it's always easy to work remote. So yeah, if I roll in, I think Thursday would be a good time to spend with you guys in the office, and then I'll probably head up towards Augusta, Georgia on Friday.
Yeah.
Yep.
Would be awesome. Chris, we're having some, I think people in the chat are saying the same thing, but TradingView is slow this morning. I think
Agree.
There's so many people staring at these charts.
Yep.
Their servers might be giving out, but we'll do the best we can for the listeners. Give me your breakdown. What do we do with a market like this? Tanking straight down 20%, positive headlines hit the fan here this morning, and we're just seeing volatility in both directions. How are you playing this?
Look, the way I'm taking this is you can take all your high VIX summaries and your, what looks to be the past and stay the course and all this. None of it matters. None of it matters right now. The only thing you can do is control your risk, control the trades and the strategies you're deploying, and survive the day. I mean, longer term, I'm taking some bites. I strongly believe this is going to settle at some point, but it's not now. I mean, all this is today is lots of volume and lots of volatility. Nick, I mean, all we really bounced off of today was the previous 2021, 2022 high. That's why I'm not surprised to see the technical move. But I don't really see a reassurance in the market to say this is great. I mean, somebody told me this morning, oh, the rumor mill that they're going to push tariffs out 90 days. Look, I saw fake Trump tweets over the weekend. It's there could be all sorts of noise in the markets. Look, last week, Friday was a systemic type day. I didn't hear China come groveling back and say, "Oh, I'm sorry, U.S. We're going to come negotiating." No, that didn't happen. Japan is saying we're going to do what's best. We want to see the U.S. basically remove tariffs from Japan, right? So it's some allies are holding their ground, and I don't think this is the way it's intended to play out. I mean, it is. Again, you're going to remember this forever, Liberation Day / what the hell just happened here. We just dropped double digits in 3 days, and it's going to hit since it's baffling that since 2018 this is the type of nonsense that traders have had to deal with, right? I mean, Volmageddon 2018 followed by all-time highs, followed by COVID, followed by melt up through COVID, followed by the great 2022 reset, followed by two years of bull markets, followed by Trump, followed by this. It's but nobody knows how this plays out. So if you're trying to be a hero and thinking a buddy just texted me and said, "Hey, is this a good time to buy?" I'm just I mean, long term, yes, but don't dump all your dry powder. Like, to me, this is not a
Yep.
time to say I'm going to get brave, because look, what is happening right now to me probably has more of a rhyme to 2008
Hmm.
than it does 2020. And
Yep.
2008 was down 56%. So I'm not calling a 20% bottom at all. Nobody knows how this is going to play out, you know?
Well, Chris, you said it well there in terms of how I feel about it too. I've been getting a lot of those same texts. I'm
Yep.
sure you spent the weekend with some of that inbound messages from loved ones, from friends. Hey, is this bottoming out, or is this a opportunity? And
Right.
I would agree fully. Long term, I think you're actually getting for the first time in a long time, some prices for the people, if you will. Like, people have been missed out. The
Right.
average person, inflation kicked their butt in 2022, and finally you've got stocks down 25%. But I think you said it well. That getting triggered does not magically mean, oh, and now markets go back up. So
Right.
I do actually think that, from my perspective, I've been saying this, like, short-term trading opportunities, I'm definitely not bullish the Nasdaq. Like, I need more solid, higher lows, some structure to be put in, some lows to be formed for trades to take place. But I'm with you on the long term. Like, dry powder is the name of the game. I've never been more thankful, Chris, about recently having a high amount of dry powder. We talked about that for a long time on streams together,
Yep.
conversations. I'm still accumulating shares and will happily continue to do so if this market does see 30, 35, 40% downside. We've talked about this for a long term. This is the thing that I think a lot of people have been waiting for, is a true panic event
Hmm.
where people who have missed out on the markets for the long term. Again, I think you can look at this as a long term, probably just fine opportunity, but that
Right.
does not mean a short term, rip your face right back up V sharp move. I think that we may be looking at a U.
Yeah, I could see. I mean, I could pull up charts of past, like, kind of ugly bottoms where if you show my screen here, this is
Yep.
why I wasn't super excited about the weekend, because what I noticed were the tape readings on Friday was that retail traders were still net long and still buying, and so this, like, oh, it's down 15%, buy the dip. That's fine, but so this makes me feel like the retail crowd has not felt the pain of getting flushed out and kind of bullied out of the market. And that might
Mhm.
be the 20. I mean, we're at 21% from peak to trough right now. It might be 30%. If this market, and a lot of this kind of behaves like a tuning fork. If you hit the tuning fork, it has one big wave, and that's essentially what we did here. We had like a little, high, low, lower, high, lower, low. But if this is our next wave down, I could see this to this, to this, to this. If we're lucky, it just kind of stays the course here to carve out the lows. But I think we're going to play some games around this bottom. We're going to play some games here. It's obviously good resistance becoming support. So if it holds there, then sure, maybe we find a bottoming pattern here, Nick, and that would be, like you said, a U-shaped recovery, something that looks like price confirmation will be good. Because the only other thing that's going to be faster would be we dump like so. We come up here and we go sideways, and then you're talking, hey, this might be a cup and handle. Well, if we break those highs, how about this, Nick? Would you still short this market if we came back up to 54, 55? Would you still be interested in maybe a short back down to the lows?
I think that if I was to get short, that would be the spot, right? I
Yeah.
think that the thing that I've been pointing out is, like, I think that if you're trying to buy puts at these levels, just like standalone, like a bearish speculative bet that it's going to go lower, I think that's a really, really difficult trade, because you are working with some very high premiums that you have to overcome before you even get into
Yes.
a profitable position. So I don't think that's the case. What do we see right here, Chris? We actually saw the put to call ratio go from extremely bearish to right in the middle, smack dab in the middle, moderate. And then that was a wonderful opportunity. If you were bearish, that was your chance, right?
Right.
So if you're bearish still, I think that you probably, even if you have a great reasoning for being bearish, I think that doesn't mean you chase. So if you get a corrective move, that's probably even like what's the 61.8 and then like 78 point whatever.
Yep.
Like, you may get that kind of move. But yeah, I think that that's a way better risk to reward if you're a bear than selling into the collapse. We saw a 6% low to high move in like 30 minutes just now, because
Yeah.
we had one sign of maybe some negotiations from EU. So that's the point, is you have to be
Wow.
really careful as a bull and a bear in this moment.
Yeah, I was gonna say on the on the hedging. I mean, I'm planning on reapplying shorts. I mean, I've been hedged since these highs. I reapplied here just in case. A lot of my hedges are out to August. A lot of them out to September. I put on some fresh ones over the weekend, and I did get paid. I put a $5 debit on the SPY that paid out for $10 credit today. I'm out of that trade, which I'm glad I am. But I'm gonna recycle those trades. And again, for me, I'm not looking to get like short. What I'm looking to do is I'll hedge. I mean, I still think I can battle through this market. I don't know if that's necessarily the low, but similar to what we had, this is just now the doors are like open, right? Like the volatility doors have been blown off. So unless this is going to calm down, I don't think these wild and crazy swings and days. It's like just like I said, risk capital and risk management is probably the most important thing. I know it's tempting, right? But I'm still sitting on lots of cash. I'm still sitting on over a third of my accounts in cash. So I'm not going crazy to deploy it. And also because premiums are so high. I mean, look at the VIX today. Hopefully everything. Yeah, I mean the VIX. We had a.
17%.
I mean, it's like we're talking about the volatility event we had on August 5th. That's how high it pushed up today. And so, I mean, our traders automatically assuming that this is going to go down. And this is another thing. There's no guarantee in the VIX. Like, I mean, the VIX has been higher. It was higher during COVID. It was higher, as high as Great Financial Crisis. I mean, this was 85 in the VIX. Is that the highest? No, Great Financial Crisis 95. I mean, and there's no reason for it to stop necessarily. I mean,
Yeah.
Nick, would it surprise you if the VIX is somehow registering like 100 during this era with like things moving faster and more crazy? That's we could have a higher VIX. So this idea of the VIX is at 45 and just sell in 1 year out, it's positive, and 3 years out it's positive. That might be true, but if we're facing something that has never been done before, i.e., Great Financial Crisis was financial Armageddon, the brink of the entire market coming down. This has similar pieces to it. Like this is stopping all globalization in like 1 week and in 1 week with Liberation Day. And I know it's not the case. Like I know the intention was we're trying to bring people to the table, we're trying to negotiate. Like I get it, but how this is playing out is so violent that I don't think the VIX necessarily has to say, oh, the top was in, because what makes that special? Nothing. Like I just feel like we're going to be in this year of like outliers, and it's going to be the most extreme bullish day. It's the most extreme bearish day. So just don't do anything stupid, man. I mean, I'm a long ways away from all-time highs for the year. I'm going to fight the good fight. I'll survive this, but I want to have cash at the ready. And yeah, there will be levels that, like if we're down, 30%, 40%, 50%, then I'm taking long-term plays. I'll deploy probably half of that capital and plan for the best. But it's still going to be a lot of options, still going to be taking good defined risk trades.
I mean,
There's no reason to do anything silly.
The thing you said, Chris, that I really stuck out to me, and for everybody in the audience that I think should hear too, don't do anything stupid like that. I said this earlier. What's the name of the game? How do you get through this? Well, nobody on this stream, nobody in politics, nobody anywhere can tell you with certainty what is coming next in this story.
Right.
So what can you do? Well, you can control if you do something stupid, right? That's something you can control today, right now. Everybody can do that to improve their chances of survival. The way to get through this, as you just described, if we see 30, 40, 50% corrections in the stock market, which historically have happened, if that's the environment that we're going in, everyone in this room should ask themselves, how am I prepared for that? Because it could happen. So if it happens, how are you prepared? Well, the answer is, number one, don't do anything stupid. No extreme amounts of leverage. Chris and I have been preaching on this show for some time, the effects of dry powder, being prepared for an environment. I mean, Chris, I think you and we know what to do in that scenario. It doesn't mean it's going to be pretty. I might lose an arm and a leg through that process, but it's going to be, we know what we're supposed to do, right? You're supposed to accumulate things slowly, little to no leverage. In your case, you like to hedge things out. For me, I like to really trade momentum on different things. I like to mix in more currencies. You do a little bit of that as well. So, there's we're going to survive through this. It's not necessarily going to be pretty, but that's what great traders do. For everybody listening, great traders doesn't mean every single day is green on the portfolio and it's amazing and it's sitting on the beach pina coladas. That is so nonsense. If you're going to survive this, right, it's going to be like a battlefield and you're going to come out surviving because you were defensively positioned.
Yeah, look, this is straight up survival. I mean, to be here's an example. Yesterday, Tasty Live, they start a futures market opens at 6 p.m. Eastern time.
I watch
They
that
they
sometimes.
start a live session. I mean, you have traders that have put in 20, 30, 40 years of their life dedicated to the markets, and even they are like, we don't know what this is going to be. Like, so part of it is just crisis management. Part of it is just like
Mhm.
talking traders down off the ledge because, you know, the one scary thing about these financial markets is they continue to add more layers upon layers upon layers. I mean, there's only, let's say, $100 trillion of global wealth, but there's $400 trillion of leverage. So that deleveraging event, that bubble at some point can be this burst. And I think what's scary about this right now is that it shows how systemic and how correlated everything actually is. Because on
Mhm.
Friday, I think I've got a screenshot of this, Nick, but the world was red on Friday. This
Yep.
is everything from 88% of all stocks declining on Friday. This is the world.
Yep.
Everything was red on Friday, and so again, this is why I'm saying it's not just a COVID thing. Like, this is 2008. This is very, very disruptive for the entire global economy. And also, I mean, think about what this is putting every investor through. Hedge funds are gonna blow up. There's gonna be liquidations all over the globe right now. Um, and nobody comes out of this happy, but those that can survive it will probably be really prosperous.
They'll
But
come
that's
out
the
of
thing
it.
is, if you don't survive,
Yeah.
you're just a statistic.
That's the thing. You'll if you are defensive, your sizing is appropriate. You're not leveraged. You'll come out of it. Period. A lot of people
Yep.
will not come out of it. That's the
Yep.
difference. Is it
Yep.
doesn't mean it's going to be pretty, and that's the thing that I think a lot of traders are going to miss. Chris, I got to run, but
Okay.
nice speaking with you. Maybe we'll see you on Thursday. So
Yeah,
uh,
I'll text you guys. I'll find out, but it should. I'm planning on it. I could travel like evenings and stuff, and I think
yeah.
a work day with you guys Thursday should work. So I'll let you know.
Yeah, we'll
All
make
right,
something happen.
thanks,
Also,
Nick.
real quick before I leave, for everybody in the room, look, this is a sales pitch, but it is probably one of the most important things I could say today. Don't trade alone during all this. Consider coming and joining our group if you are looking for a chance to trade alongside people who've been doing this for a long time. I learned a lot from Chris. Chris, you might have learned one or two things from me over the years, but you've been in it longer than me, and we run a group together. So if
Yep.
anybody is interested, come join the group. I'm serious. It is worth every dime, especially if you're just out there losing money to the market. You don't know what you're doing. Survive it with us. Come join. Pulver alerts are now available if you'd like to see what Chris is doing, or you can join our VIP group. If you have questions about either of those services, we'll drop a link here in the chat to speak directly to our support team about joining and getting a membership, trading alongside us during this crazy time. We got good years ahead of us. Don't let this panic event scare you out of life-changing opportunities in the long term that are presentable in these markets, even if they're scary sometimes. Chris, good speaking with you. We'll see you soon.
All right, Nick. Thanks.
See ya.
Bye. All right, everybody. I'm going to take a look at. I'm going to do another quick. I think a little iron condor on the SPX this morning. I've still got about $10 credit on my call side. 52. It's trying to think here. I mean, it's just a trade. I've been dabbling with the defined risk. If I get less than like $2 for this, I probably won't take the trade. Let me go to like a 10-11 delta here. 10-11 delta, $2. 47.30 is down at fresh lows. It's probably fine. Man. Do I like this trade? Not really, because that's below today's high. We spiked all the way up towards like 52.48 today. We've got lows around 48.32. I did grab some profit this morning. I ended up doing a fat finger trade on one. I did two contracts on accident, so I took a small loss on another trade. Somebody had asked, Chris, why does all your stuff show red? Because I trade so many options, I have a lot of unrealized positions right now. So, for example, I mean, I can take a look top-down portfolio. I'm still up for hedges. I've got about 50 and 20, so about $70,000 in hedges on futures right now, and I intend to see how big that pays. This ES hedge, by the way, has the potential to pay. I mean, the numbers are kind of ridiculous, but that's the beautiful thing about a leverage market like futures. And I was risking about $975 per account. So all in all, around maybe like 15 grand of total profit here or account. If I'm risking 15 grand, that potentially pays. Oof, let me do the math. So we'll go. I'll just say 40. So 41 times that. I mean, so 15K times 41. All right. So this $15,000 hedge could potentially be showing 600K of profit. Now, potentially, it's not going to be likely, but you can even see right now that I'm up 220% on my hedges, right? So all this is about survival. This is fighting the good fight. I do have some exposure in some of these stocks, but a lot of it's options. And what happens is there's so much volatility happening right now in the markets that an open position, even though I got into a lot of these like selling high premiums, like Tesla, for example. I mean, I've got a cover call for this Friday at 247. I've already collected, 81% of that covered call. Now, the question is, do I take it, roll it, and just move on, or do I let it expire and see? I'll lower. What I might do is I might put a bunch of collar trades on, which I already have some of those. So point is, you're seeing red in my account because the day is red because we gapped lower. I've got a lot of high volatility with options positions that are open, but all of my option trades are defined risk. So because when the markets widen like this, when you have like a high bid mid ask and IV is so high, you might see that it's like trading like further than your max risk. So for example, if I knew that I was taking a trade on, let me see here, trade on. I'm trying to think of one example. I did a 460 by 420, 460 by 420 bull put spread on SPY. Okay, now are we anywhere near 460 right now on the SPY? We're 497. Okay, we're at 497. So I'm still, to quote, clear of my level, but because of the volatility expansion, I mean, this is trading for basically negative $3,000 to $4,000 per contract. And so if that's on 10 accounts, it's going to show like 30, 40, $50,000 in losses, even though the trade itself is still safe, hasn't been assigned. It arguably, if it stays where it is, it's going to be profitable. But this is why I'm seeing a lot of red in my positions. I've had a lot of fluctuating unrealized ups and downs, and but as I take trades on and off, I just keep chipping away at, like, if I have a winner, close it out. Like this morning, I closed out. Trying to think, about maybe $6,000 or $7,000 in hedges. So I had a $5.10 debit that I closed out for $10. So I had a 96% win on the SPY for hedges, and I did that on 13 accounts. So that was 4.90 times 100 times 13 accounts. So $6,300 this morning in profit. Again, doesn't matter. Like, it looks like, oh, you're just red. Right, because it's unrealized losses, unrealized positioning, and that's where I'm at. So I still have time for a lot of these trades to settle. As all this nonsense was happening, I put hedges into August, September. Those are fine. That's essentially, my real protection. And honestly, those trades, to me, it's like, I hate to let go of hedge profits, but they're there to really be the protection that I need in order for me to keep trading through this and surviving through this. That makes sense? So point is, it's not going to be easy. Like, just you can pin this conversation. We can go back and talk through. I mean, every stream we've done since Liberation Day has been a little bit crazier and a little bit crazier. And what we have noticed here is that the market is way more vulnerable over the weekend than it is during one day to the next. So I wasn't surprised. That's why I showed the screenshot, right? That little retail. Again, this screenshot here. Where the heck did it go? This guy. I don't know if I got a chance to talk about this, but I think I did. This was the retail positioning on Friday last week. Okay. That's why I said I'm not really excited about where these markets are going, because if retail investors that have been convinced and conditioned to buy the dip, there's not enough pain for them to be feeling this. and I don't know where that pain is. Like we've already experienced this, 15, 20% drawdown, 20+%. I mean, Russell is freaking toast right now, but I'm telling you, like this market has a way of pushing the thresholds to the extremes that every retail trader is going to feel the pain, right? Every institution is going to feel the pain. Like the traders that come out of this are survivors. I mean, I'm reading like Bill Ackman, longtime Pershing Square hedge fund manager, billions and billions of dollars. One of his biggest plays is Google, and they could be liquidated on their position, right? So, I mean, you're going to see a lot of losses and a lot of ugliness going on that's just not worth the unnecessary risk. So, I'm just telling you from experience, throw all of your statistics, all of your probabilities, all of what you think it did in the past, just throw it out the window. I'm not saying that things don't work, okay? But I'm saying we don't know how this ends. So the most important thing is, here's what I'll say. If this market is down 50%, could you survive? If, right? So if this market is down 50%, could you survive? Because right now, yes, I can make a case for, well, we have resistance here. Well, we bounced off that and had a giant swing, but you can see that prices quickly up and then came right back down to the halfway point. So this bottom is not in, right? And if we're lucky, I would say this market kind of overshoots, comes back up. Maybe if we're lucky, creating a tradable bullish pattern. But this is the type of market where I think if we're going to find lows, it's going to be after a stab and another stab and another stab, and it's going to be something like this, where this market is going to settle in, rip up here, maybe come back down and revisit the lows again, and it's going to be very, very noisy before this bottom is in and before we're justifying a run back to these highs. Okay. I don't think this trades like COVID. I think this is more like this is systemic risk. And this is also the scary part about the entire financial market is it shows how interrelated it actually is. And as much as I'd like to say, this is like a rude awakening for everyone to say, look, trading shouldn't feel like this, right? Investing in the world, investing in the most profitable companies in the world, investing in what's supposed to be making people wealthier, it just shows how closely connected it all is. And so if the US catches a cold, the world potentially gets the flu, you know? And and you'd think like, well, that's when everyone's going to come back to the US and say, "Oh, we want to fix this." It's like, look, the US started it. So I don't think that the world is just begging right now to fix things when the US is digging its heels in as well. So that's what's like literal about this trade war is I don't know how the terms soften up. If we don't hear, I mean, it's like if all of a sudden Trump this week, like today, for example, he starts backpedaling. Like you see in the fake news, right? I mean, I've already had several comments in the stream, fake news on the 90-day push. I understand why. It's like this is what we live in. It's misinformation. It's whatever, right? It's all crap. Price is going to be your ultimate tutor and teacher. But if the U.S. is all of a sudden going to flip the script after 3 or 4 days, then it's a bluff, right? And you can say like, well, that's just brilliant. No, it's not. That is the most like distasteful way to do some type of global trade deal is to basically bully, threaten, and bluff. Like, you know how much credibility you would lose in that negotiation? Which is why I think other countries are willing to stand firm right now and see, okay, look, US is under pressure, markets are crumbling, ours are too. But in principle, they're willing to play hardball, and that's how this thing gets worse. So great financial crisis probably is the closest rhyme to this. And I know back in 2000 and 2008, which I traded through, 50+% happens, So I'm not calling 50+%. I mean, obviously I don't want to see that happen, but my point is, if it were to happen, can you survive? If this market's all the way down to 3,000 in the S&P, could you survive it? And what's even sillier is from a longer term trend line, and this is so dumb that this would happen, but this longer term trend line would actually technically make a lot of sense, right? If you have a low here from 2008, okay, and you have a low during COVID, this low and this low, okay, and somehow if price fell in a straight line, well, 3,200 to 3,000 is that bottoming point. Now, I did crunch some numbers over the weekend. The forward earnings on the S&P, everyone was worried about that, right? The S&P price to earnings was trading around 25, 26. The Cape-Shiller ratio, crazy high valuations, all-time highs, or getting up there like into those like bubbly territories. The market's never really bottomed at a 19 times earnings, ever. Usually when the market's finding bottoms, it's been like a reset of like the 23, 24, 25 price to earnings all the way down to like a 15 or 16. Just put this number on your little sticky notes. That's around a 4,000 S&P right now. That's around 4,000. So this bottom's not in, because here's the next piece. This is all trade war noise. Now is trade war noise. Next is we have earnings season that starts this week. Earnings this week. Let me try to find a screenshot here. Let's go. I'll just go. Well, Friday is what I'm watching for. Let's go StockTwits earnings, because StockTwits earnings for Friday, it's only 8 companies reporting, but listen to these names: BlackRock, Wells Fargo, JP Morgan Chase, Morgan Stanley. We're starting off with some big banks, and their tone is not going to be optimistic right now. Jamie Dimon, I've got an article right here. JP Morgan raising likelihood of recession 40 to 60%. Like, all these things are in question. Nobody knows. They can always point the finger and blame. None of it's going to help. What I'm saying is earnings is the next shoe to drop, right? So trade war noise is now, and it's already so damaging. You take earnings and you see that companies are extremely fearful. All that's going to do is revise things lower. That's all it's going to do. And that compression, that earnings compression that we see from a 25 multiple down to a 19, 18, 17, 16, that's where the soft data becomes the hard data. Does that make sense? So don't call the bottom. I know this market can do all sorts of wild and crazy stuff. We might see some rips. I mean, I have no idea. But I'll just look, here's my plan, okay? I am taking bites on high volatility at these lows. I'm maintaining hedges for right now because it's all controlled. If I want to have my cake and eat it too. I want my hedges to get paid, right? But I also want my hedges to be so profitable that it helps me offset a lot of the short-term pain that I'm dealing with right now, which is the swelling IV and all my exposure I have in options. But even if we came up to here, if we came up into this area, I mean, here is a high to low. Well, today's spike already hit a 382, just based on today's price action. Now, if we pull back to the 50 or the 61, or even pull back into the structure around that 70% zone, I'll point out a couple levels. Okay, the golden ratio, 618, magical. Does it hit? Maybe. Yes, no. Does it respond to that? Maybe. 50% would be a big one just because it's equilibrium, right? We pull back 50%. Is the market capable of going back down from there? Yes, no, maybe. The 70% zone, this would be more of a wedge potential. So we go high, low, we pull back to 70%. I could see the market coming back down, making a higher low, and then a lower high, and then a higher low, and then we're dealing with this type of structure, and it gives the market time to kind of put in the circuit breakers where the market's not really damaging the lows, but again, watching to see. I'd like to say that at some point we have like, oh, the coast is clear and it's easy to be a bull again. That time is not now. I don't know how many of you are day traders. I don't know how many of you are trading like prop firms and FOREX or trading futures, but I mean, there's enough volatility right now to make or break you. In fact, and the scary part is some of you that are in prop firms right now might have prop firms that don't survive, right? Because if this is the type of environment that's scaring traders, no money's coming in, nobody's getting paid. You might see some prop firms, like there might be another consolidation in this market, and all these things have such awful consequences. It's like, this shouldn't be how it's related and interconnected, but it is. So, and then I had an a debate with my best friend that's in California. He's a big Bitcoin enthusiast. And so his snarky comment last week was, well, Bitcoin was fine, right? Because he's pretty much all in on MicroStrategy, all in on Bitcoin, right? it's fine for now until the market realizes, well, this is all interconnected. So Bitcoin is down, to respectable levels where it should be. Now, it's still holding up. And I think this is a critical level for Bitcoin to hold, but does it firm up? And Bitcoin is, I agree, like it's a systemic hedge. I mean, right now I think like Bitcoin is taking on this whole new identity with enthusiasts that it's a systemic hedge. And this shows how interconnected everything is. The US gets a cold, the world gets a flu. And Bitcoin is like, well, we're okay for now, but there's no guarantee here. There's no guarantee here. There's no guarantee, and the VIX is up to 45 and 1-3. I mean, I saw it. Charlie Bilello, I love that guy. That guy's got tons of great data. I listen to his creative planning stuff every week. Tons of data. But that playbook doesn't apply if we're going to see more trouble ahead, the highest VIX on record. None of it matters. The only thing you can do is survive. That is truly the best thing. If you take now for the next 6 months to 12 months is do whatever you can to still be trading. Because if you're still trading, you're probably going to be fine. But if you are overexposed or this little blip, I mean, here's an example. So I'm red, right? I'm down 150 grand. Okay. 150 grand. Oops, 150 grand. I'm down 5% right now for my portfolio. Open positions, floating P&L, I'm down 5%. Can I manage that? Of course. Can I survive that? Of course. What makes this worse? Well, if I was seeing like $500,000 down, if I'm seeing $1 million down, I'm clearly overextended, overexposed. I have way too much leverage in my portfolio, way too much tilt in my portfolio. That's when I wouldn't be talking to you if that was me. Like I've never survived that way. So if that's you, where it's like your account's down 20, 25, 30, 50%, it's way too much leverage, way too much exposure. And unfortunately, these will teach you how to change that. Like you can't survive when you're one ugly push away from blowing up your account. And early in my career, I've had those scares, especially in Forex. I had flash crashes that, took me from a 2% drawdown to 10% overnight because I like to trade small, but with a 1,000 pip move in a flash crash, I'm exposed to that. Which is why I traded smaller and I started to add more to my winning side versus my losing side. And then I started migrating into way more stocks and options because I feel like you can put a line in the sand in. So anyway, I'm just trying to be objective here. Nothing about this market makes me comfortable. Okay. I don't think there's a bottom in place. I think that if you look at the charts, there's a lot of reasons to say this could be a technical bottom, which is what we're seeing the response off today, but it's going to be a noisy day to day. So if you're in the market every single day, it's going to be noisy. Just be prepared for it. Trade appropriately. Trade smaller. Don't be a hero. There are levels that I'm really interested in. There truly are. But until I feel like I have the coast is clear where I can say I'm going to put on a leap, I'm going to go longer term. I don't have that yet. I don't have that yet. And so I will say this, like, if we get I'm going to put a bottom area here in quotes, and that was around that 16 times multiple that I was talking about. So if we have a earnings compression and it's trade war noise followed by earnings revisions lower, followed by, and here is truly the biggest takeaway from the economy is going to be your jobless claims. Okay. If you think that this market's going to roll over into a recession, here is your biggest takeaway. And we don't really know this data until probably after September. So if there's any type of resiliency in the market, the federal government is pushing out all their layoffs until September. So the data that we read is like, oh, the federal layoffs. Well, if Main Street is going to feel layoffs before then, this is one thing to watch. This is a boring little indicator that prints every Thursday. Nobody pays attention to it. But if these jobless claims start going higher, okay, then what we are doing is we're stacking on trade war uncertainty, okay, which is taking on global friction and global economy suffering because it literally halts globalization as we know it. And then you take on U.S. earnings, which are probably going to be revised lower, likely revised lower. And then you take on job losses. And on top of that, you throw in sticky inflation. Okay. Possibly sticky inflation. You throw on a Fed reaction. Okay, the Fed put is not now. The emergency measure of the Fed to be reactive is not at a 20% pullback. The Fed would step in if we're on the brink of a financial freaking collapse like we were in 2008. That's a 40, 50, 60, who the fuck knows? You know, it could be 50, 60% lower, it could be 80% lower. Nobody knows. But the emergency measures is not now. Now, from 2008, we've learned a lot. You know, there's been a lot of stress tests put in place and a lot of, you know, mechanisms put in place where we shouldn't really have to experience the 2008 all over again. We shouldn't have to. But the cycles can be faster and uglier, right? So you throw job losses on top of that. This is the thing to watch. Like, all these things add up to the worst case scenario. And so right now, this is happening, right? Global trade war. Okay. So that's happening. More global friction until it's resolved, until there's more, you know, like open communication. This is happening. US earnings has yet to really be seen as revised lower. Everyone knows it's coming. It just hasn't been priced in. Well, now the market's dropping. The S&P is a good barometer for the markets. It always has been. But clearly, Wall Street and the economy are very different things, right? Main Street, Wall Street, Main Street, very different. But job losses have yet to tick up. You know, the federal government's kind of suppressing that data because most people are getting paid through September, even though they've been fired. They're just not on. They're not showing up as data points until September. And if they don't go back into the workforce, or they struggle to go back in the workforce, then this starts to spike higher, right? Sticky inflation, we will see. True inflation readings are lower. That's encouraging. But I mean, tariffs is inflationary. You know, if we're talking about onshoring, the whole reason of globalization is you do things that we can't do, so we want to buy from you. But now we're going to say, well, you do that, we don't like it, we're going to bring it back to us. There's no way the US can pay for everything to be made here. We're not going to make avocados, we're not going to make mangoes, we're not going to import bananas. You know, it's like, sure, we want to do essential infrastructure like semiconductors, building our cars, sure, but we don't make jeans, textiles, everything that we consume on a day-to-day basis. Like, half the crap, 90% of the stuff's not made here. But tariffs is going to cause more global friction. It's going to cause stickier inflation. Prices are going up. And the question is, are producers going to take on that higher cost, tariff cost, and try to pass it on to the consumer? Because if it goes from producer to buyer and we're paying for it, then it's obviously inflationary, prices go higher. But all this is why I'd say this is probably the closest resemblance to 2008. You know, and I don't know how bad it gets. I hope that there is a lid on it, but I don't know. And I'd rather not put my line. I'd rather not dig my feet in and say there's no way the market can go lower. If I take a huge risk right now and the market goes lower, that's on me. If I take little tiny fractional risks, I can survive. Like right now, if I'm going to blow up like all of my trades right now, if I blow up all my trades, I'm probably still maintaining a less than 10% drawdown, realistically. I know the trades I take, a lot of my risks are always like quarter 1%, maybe half 1%. And that's showing up like in red. You know, that's like all of my accounts, all my positions open, and they're all kind of blown out to worst case scenario. And that's okay. But my levels are still pretty fine. It's just I need price and time to you know, like settle down a little bit. So there's a lot ahead. What I'm looking for is in the next, let's say, I'll say this. I think I talked to Nick about this last week. You know, if you remember, COVID played out during 2020. Okay, COVID was a full cycle, and if you don't think options are so important in the market now, then COVID is your lesson. Because what happened during 2020 was we had basically the world is ending as we know it, and the market went from one monthly cycle from February to March. Okay, look at this. The world is ending as we know it, and this market went from a high around Thursday the 20th in February to a low of around the 20th of March. That's essentially one monthly expiration to the next before the market bottomed. Okay. Guess what our monthly cycle is now? Guess what it is now? April 17th. So it's not this Friday, but it's next Friday, right? because this market is so much faster than it has been in the past, I wouldn't be terribly surprised if there's a very noisy week this week. We should have inflation data coming this week on Wednesday, Thursday, if I'm not mistaken. New Zealand looking to cut rates. Okay, Wednesday, FOMC meeting minutes at 2 p.m. That'll be interesting. Thursday, CPI data. Is there no PPI? Yeah, so they moved it to Thursday, Friday for whatever reason. But we do have the inflation numbers coming this week. You can see that the year-over-year CPI headline is supposed to be 2.6. Okay, I mean, maybe it is lower. It's still not 2%. Is it enough to make the Fed act and say we're going to cut rates? Well, it's already forecast now we're going to see 4 or 5 cuts this year by the Fed. So everything according to this, you got to ignore the nonsense right now because prices are down so much, but it's not going to force the Fed to do anything, right? The Fed is going to stay, hey, look, we now have the data to say we can start cutting rates, but an emergency cut will probably have the same influence that last September had, which is Fed cuts rates, bond markets do the exact opposite. Okay, so I think right now the Fed should do nothing other than just stay the course, see if the data is coming in as it should, that they can slowly lower rates this year, right? They can soften the cycle if inflation is improving. I think inflation should be the Fed's number one priority. The stock market is not the Fed's priority. It's really not. It's funny right now that the president went from being the biggest cheerleader back in 2016-17 as the market's making all-time highs, look at how awesome this is, to now stabilizing the bond market, trying to lower treasury yields, trying to get this air pocket of liquidity in a better place in the next 4 or 5, 6 months, which is why I see the purpose of this crazy crash in the first place. But to then immediately start to chirp about, come on, Fed, do the right thing. Like, I think that was fake this morning. I don't think that was a real Trump account that did that. But if that starts to be the noise, then you have a president that's now trying to jawbone the economy back up. That's not going to work either. Like, this is going to have to settle somehow, and we're still a long ways from it. All these things have to get played out, and that's what I'm saying. Like, this could be a very ugly, wild. We could be up to 53, 54, 5,500, come all the way back down to these lows again, and just make everyone's head spin. But I will say this: if I have opportunities to re-hedge up here and see it play out back to the downside, there's good opportunities there. If I resell and redeploy some capital down here, take some stabs at it, define risk, I can make some money there. Eventually, when the dust settles, if we can spot some bigger bullish pattern, it's easier to trade. I'm going out 12 to 24 months. Cool. We survive it. We maybe pull in some nice short-term trades in the interim. And when it's all said and done, we survive number one and we make some money on top of that. That's all good. Okay. But there's probably going to be a ton of noise in the market. It's going to be a bunch of fake news, double and triple check your sources, which is obviously difficult in this day and age, and nobody checks sources. Everyone's just like at face value. Oh, I saw it on social media. I mean, I will probably stick to the 3 or 4 financial newsletters that I follow the most. That's their job. The integrity is they find real sources and they give me real data. So that's what I'd be following. Make sense? Okay. So here's what the day looks like. What's funny is 2 or 3 weeks ago, this would be like such an easy day to trade, but we have gone from 48.30 to 52.48. That's a 400-point swing in the day, and we settled right back in the middle. So, I am seeing a bit of a fight today. I wanted to take, a trade to kind of sell premium both sides, but the issue is let me check and see something. It might be, I don't know, if I go above here to like 50, 54.50, lows at 4,800. Let me just check something. I might put on a little 5 wide spread for the end of the day, but I think that's also unnecessary exposure in case the market isn't liking this. So let me go down to SPX for the day real quick, and I'll let you go. So we had 52.48 was the high. Yep, 53. Yep, 58.50. So 52.50. That's still a 12 delta. Ugh. Okay. So will this fight a little bit? And I'm still not pulling in the premium. I want to pull in like $1 more premium. Let me see what this is in a 12 delta put. 12 delta put 48.45. We had the low of the day at 48.35. It's like that's still not even that good. 48.33. I'll go down to 25. So I get 90 cents, 80 cents to risk $400. I'm not going to take it. I'm going to pass. All right, let me do some currencies real quick, and then we'll go. I'll give you a couple minutes. So let's go currency strength. Okay, lots of volatility like we saw on Friday as well. Crazy amounts, over 600 pip swings on Friday. Friday was like a systemic day. Literally that felt the same as, I remember what COVID felt like. I remember what 2008 felt like, and that's what it was. Everything was red. The world was down. 88% of all stocks declining. Currencies all over the place. Safe haven flows. So today, everything's choppy, but we had a kind of a blowout move right at the open. So Swiss and JPY just blasting higher. Aussie blasting lower again, like ties to China, risk on, risk off trading. But now it's all kind of been contained within. What's crazy is now it's like from a 300 point pip blowout into now trading within like a 50 to 60 point range. Very, very different stuff, right? So watch your levels. I'll take a quick peek here. Dollar index coming back a little bit, maybe grabbing some safe haven bids. Dollar came into the 101 level. I think this 101 to 100 is still a play out point. I don't know if the dollar's done. I don't think that it is. But don't be surprised if the dollar comes into here, between this area. I still have pockets in here. I'd still be looking to short the dollar back down into these lows. But right now I'd say the dollar's catching a bit of that safe haven play. So if things settle back in, I could see the dollar coming up to some great levels at the 10, let's say 104, 105, 106. You can either try to trade really small and level into that, or just wait for a smaller time frame alignment confirmation, and then take it back down towards the lows. Okay. Oil, gold, silver really quickly. Oil, I'm not touching oil. Gold, this is the turn that I didn't expect gold to have to pivot on something like a global trade war. But technically speaking, have I not been talking for now 4 months on gold getting short? I want to wait for a pullback. I'm going to get more gold exposure. I want this. Well, what do we need? Well, we needed some event, I guess, to turn gold. So it's stretched up here towards like 15, 16% away from the 200 moving average, 370 plus bars, and it's now falling right in line with everything else. So, maybe there's a pullback to, I don't know. I'm not going to short gold. I'm going to try to wait and see if it will settle back into this previous high or find my 144 200 moving average, and I'll start looking to get long gold again. Silver, absolute, crash and noise, but starting to stabilize. Copper, looking a little bit better. Bitcoin, still good, but came back down to a pretty key level there at 75. MicroStrategy till 280. Here's copper. I'm going to keep a very close eye on copper. I had profit in copper, about 90+% of my max profit, and I think that expiration is coming sooner than later. But I'd like to see copper stay above 4.2 if possible. Copper is still going until the 24th, so out a couple more weeks. So, not big risk, but still watching, because otherwise it'd be up like $6,000. So that's part of the reason it's like, everything changed. So all my futures contracts have been blown open. Even though it's defined risk, it's still blown open. So I got to let prices just settle back in. Okay, Japanese yen. Japanese yen made some fresh highs, but we are pulling back. The Nikkei, just absolute trash. Same thing on the U.S. market. We're back down to the August lows in the Nikkei. FXY, this is my Japanese yen long shares. Okay, I want to do more currencies here. Mag 7. Apple at 177. Amazon, spiked all the way up here towards 183. There's still like hedges galore. So just, I don't know. They're great companies, right? I like all these plays on Mag 7, but the dust has to settle. You're getting some pretty awesome discounts. There's just no guarantee that, Google's going to stop going down to 30%. Google could be 40, 50% if it gets worse. Mag 7 has been by far, one of the worst performers. And until I see more encouraging signs of this thing bottoming out, we did hit symmetry. We could go a little bit lower. Just be careful. Berkshire, well, that was a big difference. Right back to the 200 moving average. And this is a company that has 20% cash. This is the company that called the top. They were worried about the economy. Well, they were right, but their stock is still going to suffer. So that's the hard part, is sometimes it's just there's nowhere to hide. Freaking bond market today, right? 10-year yield is way higher. I mean, the TLT has gapped from a $94 move and it's down. So, I mean, does that make any sense? Market's in turmoil and bonds are like, we're going to drop. We're going to drop 2% today. All right, let's get to some currencies and then I'll let you go. I've got to go in just a few minutes. One real quick thing on the son of a biscuit. Well, 11.3 is my reading on the S&P above the 50-day moving average. That does make me want to get a little bit more bullish. Gosh darn it. You would put that position in my face. And the Nasdaq. Look at this thing. Holy crap. All right. I'm gonna place a trade. It's gonna be defined risk, but I'm probably gonna give myself about a 60 to 90-day window to see if these lows can hold. I know this isn't a guarantee. There's obviously ways for the markets to still get worse. But with the S&P and the Nasdaq, you've got 500 stocks that are 89% of them are below their 50-day moving average. Now I go back to 08. Okay, let me go back to 08 here. I guess I don't really have, that's annoying. I don't have that data. Come on now. There we go. So go back to 08. And the one thing, this is not called a bottom, by the way. This market went way lower. There was a short-term opportunity in here to buy the dips, but every time this was the market just falling. So like I said, define risk, 30, 60, 90 days could help put in a near-term bottom, but I think it's got to be that. It's got to be a short-term play, 30, 60, 90 days, see if the market can catch a bid. But I've been talking about this. I mean, the sign is there. So that's encouraging as far as like timing the market a little bit, because it's been such a good indicator in the past. But I think if anything, this is going to offer up a short-term relief rally to then be a bull rally in a bear market. So if you look at your S&P, bull rally in a bear market, I think this market would be very thankful if this level can hold. I think it's going to be noisy, but I mean, you can see that this out here is very scary, because for now, I mean, I don't know how many years. I would guess, I mean, for over 15 years, this market has been in a bull market that had, yes, like existential crisis in 2008, 2009, existential crisis in 2020. But the health and safety of this market probably relies on this 200 moving average weekly time frame. So this red line, which is now valued around 4,700, in order for the bulls to maintain some semblance of a good, healthy market, we've got to hold those lows. If we give back these lows and we're in open space here, nothing looks good. That would be that'd be death. I think you'd see a complete fundamental change in the entire market. Nothing is good if that happens. So you just wonder how quickly things can kind of resolve and get settled in, but it's not ready yet. All right. Anyway, we'll talk more about that tomorrow. Currency wise in the day, I'm going currency strength. There's a lot of chop here. We could have a little bit of another expansion coming for the next 24 to 48 hours. Don't be surprised if the Swiss is strong and the Japanese yen is strong. Those are your safe haven flows. Your Aussie, like it was weaker, probably going to stay weaker. So I would suspect that it's going to be dollar, Swiss, maybe Japanese yen. And I put maybe because Japanese yen is always a wild card, but Swiss is probably like the more stable safe haven for right now. Okay. But if you're trading like, Euro Aussie, Euro CAD, Euro New Zealand, be careful. Pound Aussie, Pound CAD, Pound New Zealand, be careful. Watching the dollar index closely. I think the dollar is still a sell position once we get up to those DXY levels. I'm still going to stick with my Aussie, New Zealand, Aussie CAD, New Zealand CAD. Those are fine. I'll work through those trades. I'm still holding Swiss pairs, just not looking great right now. So I'll just hang in there. So, all right, I'll let you go. More to come. It's going to be it's a crazy day. And we'll probably say that every day until we know that the coast is clear or feel like the coast is clear. But one encouraging sign is the S&P 50-day or 50 period. A lot of stocks down, and same thing in the Nasdaq. So I could see a short-term rally, just based on those conditions. But it would be short-term. It would be defined risk, and that's a pretty easy swing trade to take a stab at it. So, all right, I'll let you go. See you tomorrow. Thanks. Bye.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. All month long, you can get the Edge Finder 40% off, our best discount of the year. Check out the links in the description below to visit the Edge Finder homepage, or speak with a team member directly to get the 40% off discount now. Trade safely, and we'll see you tomorrow.